And probably one of the most practical applications is covered in Unit 2, which is loan repayments and loans, mortgages. Now you ask, well, mortgage is a loan. It is. It's just a mortgage tends to be a registered loan on a piece of property. Okay, that's the only real distinction between a mortgage and a loan. But for the purposes of analysis, a mortgage is a loan. So what we need to be able to do is to be able to analyze mortgages. And from an accounting point of view, we say we got to be able to figure out, like, how much, if we're doing our financial statements. I know where you guys are on your managerial, on your financial accounting now. You know that the report or the business cycle of a business would say, okay, we have this much assets, liabilities, and owners' equity at this point in time. And then a bunch of stuff happens, and then we do another report of where we are every year, let's say. So we know that some mortgages are going to have will fall across the year. So we need to be able to estimate how much, or to give a really good estimate of how much we owe on a loan or a mortgage at the end of the year. So for the purposes of the financial statements, we need to say, okay, we owe this much money, and we have had this much interest expense. Okay, so the math that we're doing here is really to answer those basic accounting questions. How much do we owe, and how much interest expense do we incur? So for the purposes, then, we need really kind of to hit our minds around loan amortization is really one of the first issues. And it's a very important one, because this is something you will be doing throughout your business career, is saying, how much do I have remaining on a loan? Or what portion of that is principal, or what portion of it is interest? So one of the things we need to know is how to do loan amortization. And again, it uses all the tools we've covered. So if we think about the loan amortization thing, paying off a loan is a process. We know it's a process. You pay an amount of money every month, or every half year, or every year, depending on how the loan is arranged. You pay that amount, and that amount pays down the loan, plus it pays the interest on the loan. So the rent on the money, you're paying for that, but you're also paying off the loan in terms of the principal component. So those loans will have a principal component, which is paying off the amount that you borrowed, and an interest component, which is the rent on the money. So we need to be able to calculate that. If we look at loans tend to fall into two basic categories: short-term loans or long-term loans. Okay, mortgages tend to fall into the long-term loan thing, whereas other types of loans, short-term loans, would probably be less than a mortgage. A mortgage is probably 25 years, whereas a loan may be somewhere in the 10-year range, or a year, or somewhere between 1 and 10. That would be more short-term relative to a mortgage. So a loan is normally done for major purchases for a company. So if you buy a vehicle, machinery, real estate, usually set up as some sort of a loan. And in a term loan, periodic payment is usually fixed interest rate, say 5%, that is fixed over the duration of a loan. Now, the reason that they're short term is we know interest rates vary. So loaning companies, banks, whatever, don't really like the idea of a long-term loan that has a fixed mortgage rate, fixed rate, because they can't predict what the future is going to hold with regards to interest rates. So normally, if it's somewhere between 5 and 3 years, they can say, okay, we can tolerate that. So if a loan is for the purchase of a vehicle or equipment, the term of the loan is typically 3 to 5 years. So payments are usually calculated to repay the loan over a longer time period, such as 20, 25, 30 years. It's called really more of a mortgage. So longer term would be more mortgage oriented, whereas shorter term would be just considered a term loan. Typical loans are secured in some way or another by the asset, or in the case of a mortgage, the real estate that you're buying. Okay. In order to be able to calculate then a term loan, the mechanics of calculating it is we need to be able to figure out what the payment's going to be. That's probably the very first thing that you're going to want to say. Okay, if for example you can go borrow $1,000 and you say, okay, I'm going to pay this $1,000 back over 5 years, and I'm going to pay 10% interest rate on it. We might ask yourself, well, what do we pay per month? What, or per year, or depending on what the schedule of repayment is, what are we going to pay? So we need to be able to figure that out. In order to do that, what we use is the present value formula that we've seen. The present value formula for an annuity is PV, and you can see it written there instead of me trying to fuddle through that. So we know that we got to worry about the number of periods, and we know we got to worry about the periodic interest rate because I and the minus n is there. So we're basically going to calculate, if we know the present value is the amount of the loan, and we know the interest, and we know the number of periods, we could be able to calculate PMT, which is the payment. So instead of calculating the present value like we've normally been doing, what we're going to do is calculate the payment. So we've got all the other information except for the payment. So we're going to basically run the formula and calculate PMT based on the information that was given us. So we have to do that, and that is a pretty straightforward thing. If we got all the information, we just plug it into the formula, and voila, out comes the amount of money that we have to pay on the loan. The next thing we need to do for the purposes of the accounting issue, as I mentioned, is we're going to figure out how much interest is really part of this and how much is principal repayment. So the first thing we need to do is determine the interest component of a given payment. We simply do that by taking the periodic interest rate and multiplying it by the balance on the loan. So if we had a loan, for example, of $1,000 and we're making our very first payment, so we say, okay, this is a 5-year loan, 10% interest rate. So $1,000 times 0.10, which is 10% interest rate, says $100. So there's the amount of interest that you have for the first year. Okay, so that would be pretty straightforward to do. We can calculate the periodic interest rate. Using the periodic interest rate and the principal, we can calculate the interest portion. So if we can figure out the interest portion, and we can figure out the payment, well, we know that the payment is made up of an interest portion plus a principal portion. So if we got two of the items, we know what the payment is and we know what the interest is, we can subtract one from the other and we can get how much is paying down on the principal. So we can clearly figure out how we calculate the principal. So the principal portion is simply the payment minus the interest portion. And what we can do for each payment is we can create a table called a loan amortization table that represents that information of how much we have to pay each payment period, how much of that payment is interest, how much of that payment is principal, and what the balance is at the end of the payment period. Okay, so here's basically a typical table and the typical headings that you have on it. You have the payment number. So if you're doing 5 payments on a loan, say a 5-year loan, once a year, $1,000. So we'll have 5 payments. The beginning balance of the principal really is going to be the beginning balance in one period is the end balance of the previous period. So the very first amount that we're going to put in there is the amount of the loan, because that's what we borrowed. Everything else we put in there is going to be what the balance was at the end of the previous period. The payment amount, as I said, we plug in the present value formula. We just plug the information in there and we'll get the PMT. The interest portion is just the principal balance at the beginning of the period and multiplying it by the periodic interest rate. And the principal portion is just the payment minus the interest portion. And the end balance is simply the beginning balance up at the beginning, less how much you paid on the principal, and that will give you the end balance on the principal. So with that bit of, I'll call it table setup, we can take a typical example. And these slides that I have here just explain exactly the same thing. I just pulled them right from the book. So here, for example, is this example that I've been throwing out for the last little while. The borrow $1,000 for 5 years, 1 payment per year, 10% annual interest rate. So we know that we have to use this formula right here in order to calculate the payment. So here it is right here. I've got it. I'll just zoom it up. I'll bring it up here just to kind of make it look a little bit bigger for the purposes of this. So in the case of here, we got a present value. We know we borrowed $1,000. That's the present value. We don't know the payment. That's what we're looking for. We know the value I, 10% annual interest rate. That's 0.10. And we know the number of payments. That would be 5 years, 1 payment a year, 5 payments. So we just put that basic information into this formula. When we do that, we'll get 1,000 equals PMT times 3.791. We take 10,000, take 1,000 divided by 3.9791, and we will get a payment of $263.79, 80 cents, let's say. Let's just round it off. Okay, so there's $263.80. So I'll just slim that back down there. So effectively what's happening here then, what's happening here is that here's the table that I've highlighted up here. Here's the headings. And so payment for year one, the beginning balance was 1,000. We calculated the payment amount over here to be $263.78, 79, 80 cents, round there. Okay? Rounding is going to cause those differences. Don't worry about it. So the payment is that. The interest portion, as I said to you, if you take the beginning principal amount and you multiply it by the interest rate, the relevant periodic interest rate, in this case is a once a year payment, so 10% on once a year is 0.10. So $1,000 times 0.10 is $100. Okay? So then we say, okay, can we figure out the principal portion? Well, the principal portion is simply the $263.78 payment less how much interest we paid, which means that we paid $162.76 on the principal. So in order to get the ending balance, then we take the $1,000, we subtract off the $163.76, which is the principal portion, and that will give us $836.24 as the ending balance at the end of the period. That ending balance then becomes the beginning balance for the next period. So $836.24, we're going to carry it right down to here. The payment amount is the same every month. Could be different on the last month, but generally it's the same every month. So we just transcribe down $263.78, which is the amount of payment. We know that the interest portion, well, the loan that we borrowed, in year two, was $836.24 still outstanding. That was going to incur 10% interest, so $83.62 is the interest. We take that interest amount, we subtract it off the payment altogether, and that will give us how much goes towards principal, which is $180. We take that and we subtract it from the beginning balance, the principal amount that we paid. That means we got $656 left. So at the end of year two, we owe $656.08 on the loan. Now, instead of writing out all the mechanics here, I've just put down the quick answers. So we got here, let me go back. Here, this 656.03 becomes the beginning balance in year three. The $263 would be the payment amount that we've determined. So we'd say, okay, well, what is the interest portion? Well, it's the 656.03 times 10%, which is $65.60. That's where that comes from. Then we say, okay, well, how much of it was principal? Well, we know we paid this much. This much of it was interest, so $263.80 minus $65.60 is $198.19. Now, there are rounding errors here, but effectively brings it down to $188 is how much you pay on the principal. That principal then would get subtracted off the beginning principal, and it will give you a balance of $453.83. The end balance in the previous period becomes the beginning balance in the current period. So there it is right there. The payment is $263. We say, well, how much is the interest, the component? Well, 10% of 45.38 is 45.78, or, you know, again, rounding starts throwing things off here, but generally it's around $45. I'll change that to 38. And then the principal portion is the difference between what you paid less the interest. And there you go. There is this amount right here. Now I'm running in the rounding errors again, and it gets magnified as I go through because I did the math on this and I copied down the numbers without putting too many decimal places. So the difference then we paid this much towards principal. This is the payment. That's how much is left. That 239 we owe basically 239 at the beginning of the period. We actually paid 263.80 because there was interest of 23.98. The principal portion then is 215, and basically that brings us down to zero. We pay off the loan after year 5. So this is how these amortization tables work. Normally we would put them into a spreadsheet, as I thought about doing before I put this up here. Now I'm saying to you I should have done it before I put it up here. That way I wouldn't have any rounding errors, or wouldn't have them to the extent that I do. And this table then allows us to calculate our status at any point. So year 1, year 2, year 3, year 4. If someone asks you, how much do we owe on the loan at year 4? $239. How much total interest did we pay after year 4? Well, if we added up the interest, 100 plus 83.62 plus 65.60 will be the total amount of interest that we paid on the loan up until year 3. So we can do a lot of things with this table in order to be able to answer some of the key questions that would be asked by the accounting people with regards to what does our business owe at the current time at the end of the period, or, for example, so that we can reflect a true value of what we owe and what we own in the business and make the financial statements be information rich, we'll call it. Monica bought a $1,250 TV set for 20% down. So she didn't borrow $1,250. She actually borrowed $1,000, 20%, $1,250, I believe is $2,500 if I'm $250 if I'm not mistaken in my head. And with the balance to be paid with interest at 15% compounded monthly in 6 equal monthly payments. So it's compounding and the payment is monthly. Construct a full amortization schedule for the debt. Calculate the total interest paid. Beginning principal balance, payment amount, interest portion, principal portion, and the ending balance. So I have a columnized table here. I'm going to say payment number 1, and the beginning balance on this particular loan. Yeah, I'm just going to leave this now. So the beginning balance on this particular loan, we calculate it to be, she's paying 20% down, so 20% of $1,250 is $250. So the beginning balance on that loan is $1,000. Beginning balance is $1,000. And it's 15% compounded monthly. So that's 15 divided by 12 would give you the value of I, okay?